What's going on, you guys? Welcome back to another M1 Finance multiple streams of income dividend portfolio review. We're sitting at just under $33,000 for the current portfolio holdings. We're up about $7,634, and we're also up 38%. And we've got different slices, different industries across the spectrum here sitting in this portfolio. But among them is SCHD. And if you guys have been following, I've been trying to move this SCHD ETF over without creating a taxable event, number one. But also, I didn't want to risk impacting the accuracy of the data from this chart. I've been doing some research, and there have been a number of different people with M1 Finance accounts that have reported that when you call in to M1 Finance, if they move the stock for you from, say, one pie to another, or in this case, this SCHD Schwab US Dividend Equity ETF, it's not in any folder, it's not in any slice right now, and I wanted to move it into this dividend ETF slice, but I've been having difficulty doing so. And multiple other YouTube channels have reported that when you call in, it messes up the data here. So I've been trying to move it using an alternative strategy, but I haven't had very much luck. So I may just call up M1 Finance sometime this week or next week and just see if they can move it over, as long as they can confirm that they won't mess up my data here, because I don't want to mess up this chart. Anyway, so that's where we are on that one. A lot of people were asking, hey, Ron, what's going on with SCHD? We were able to get it moved over, so that's the update on that one. Now, amid high inflation, over 36% of employees earning six figures a year, $100,000 or more, are saying that they're living paycheck to paycheck, which is crazy because when I was growing up, I remember that, $100,000 a year was like this magical level of income that was only attainable by doctors and lawyers. And now it's like, here we are in 2022, and if you make $100,000 a year, you may be finding yourself living paycheck to paycheck. Now, inflation is beyond where we've ever seen it, or at least in the last 20, 30 years. And well, more and more people are finding themselves earning 100 grand a year and broke. So it says here, more than a third of high-earning American workers feel strapped for cash, a share that has risen dramatically in recent years, which is really odd that the number of people who earn $100,000 a year and are living paycheck to paycheck is growing. It says here, 36% of U.S. employees with salaries of $100,000 or more are living paycheck to paycheck. So that's like that's more than a third of people who make 100 grand or more per year are living paycheck to paycheck. It says here it's twice as many who said that they were in or living paycheck to paycheck back in 2019. Now, that's more than 34% of workers who earn between $50,000 to $100,000 a year who are living paycheck to paycheck, though lower than the 52% of paycheck to paycheck workers with incomes that are less than $50,000 per year, according to the survey. Now, it goes on to say, employees at higher pay levels aren't immune to living paycheck to paycheck. Will Towers Watson polled 9,600 different full-time employees from large and mid-sized private employers in December and January 2022 before most of the recent inflation readings. Now, they go on to say that inflation may push more to live paycheck to paycheck. Rising food costs, transportation, and other areas of household budgets may put further stress on families' ability to save money. Now, here's the thing. You got houses, you got housing expenses, and debt presents budget challenges. Now, the drivers of financial stress differ depending upon income. It says here that the higher income or highest earners cited housing expenses as the most acute challenge, whereas low income earners were more likely to report difficulties with debt, for example. Now, me personally, I found myself in quite a bit of debt when I was getting started early on in my early to mid 20s, and I grinded it out just to get out of debt as quickly as possible, kind of follow the Dave Ramsey snowball effect, or I forget what do you call it, the baby steps. and use the debt snowball to kind of get my way out of debt. Now, I didn't follow the pay off the lowest balance first and move forward. I know the psychological benefits of that and getting the easy wins, but me personally, I decided, hey, I'm going to knock out the highest interest rate debts first. And that's what I did. So I knocked out all the highest interest rate credit cards I had first. I actually started off by just trying to roll them over into 0% interest introductory credit card offers. That way I could focus on the ones that remained that were high interest, and I just knocked them all out, paid off the cars, and started knocking out, chipping away at the mortgage. Uh, Personally, I decided not to pay off the mortgage just because I felt like, as low as interest rates were for what we got, it didn't make a whole lot of financial sense to pay off the house. I'd rather just, allocate or put that money into a fund or a business venture that's going to yield me way more than I would earn from the savings of the mortgage being paid off. So that's what I did. Some people, prefer the benefit, the psychological benefit of having a paid off mortgage. But the more I thought about it, I was like, you know what? Here's the thing. You pay off your house and you're still going to pay property taxes. You're still going to pay utilities. You're still going to pay, the homeowners insurance. You're not going to have a $500,000 house or $1 million house, however much your house costs. Even if you had no mortgage payment, you're not going to not insure it. That would be silly to have a $500,000 to potentially $2 million asset not protected by some kind of insurance policy, right? Like, that's just not smart. So, the only thing you really get out of by paying off your mortgage is eliminating some interest. So then I just started thinking to myself, it's like, okay, well, how much interest am I going to save? Let me just, because, if you're, what I decided was I would rather just make up the amount of interest in the form of profit from some other investment versus locking up all my money into a house. Even though there's some peace of mind of knowing that it's paid off, it's still not. It's not like it's going to eliminate any kind of cost associated with the house. So thinking back on it, it just wasn't as attractive to me once I actually did the math and got over the emotional aspects of quote unquote having a paid off house. I just didn't think it was smart. So that was me. But so, looking at people who make $100,000 a year, it's kind of like, I would really have to question what's going on. Now, no, $100,000 a year does not go as far as it used to, but I know a lot of people who make $100,000 a year and they spend like they make $1 million a year, and it's just like, look, are these people who have exuberantly high car payments that they don't need to have right now? If they're complaining about having no money left over, if they're living paycheck to paycheck, are they driving too much car for where they are financially? And I know a lot of people fall victim to this social culture of trying to look successful, even though, financially you should probably hold off. And this appearance of the social stigma of trying to look like you're doing better financially is harming a lot of people. I can't tell you how many women I've met, and nothing against women, but they're usually the ones that are buying expensive handbags, and I can't tell you how many times I've run into women with a three to $5,000 handbag, and there's no money in the bag, and the bag costs more than what they even have in their checking account. So it's like, and that's not everybody, but I'm just saying, it makes you wonder. Out of the 34% of people who make over $100,000 a year that are said to be living paycheck to paycheck, I would wonder, how are they spending the money? Because, not everyone spends money the same way. Yeah, that's all I'm going to say on that one. Moving on. So the Fed's next interest rate hike might be the biggest in decades. And so the question is, how is this going to impact mortgage rates? Are we going to see mortgage rates hit 6, 7, 8, 9% interest for mortgage rates, or what? So word on the street is that the Federal Reserve may raise interest rates by 1% at their July 26th meeting, which is in 5 days, as they, try to quell inflation that's now sitting at a 40-year high. Now, there's speculation about a 1% rate hike at the meeting. Now, if the Fed does hike rates, what is this going to mean for mortgage rates? And even at the onset, when the Fed just raised mortgage rates, or when the Fed first raised interest rates by 0.25%, I watched mortgage rates jump over 1%. So it was like the mortgage rates were climbing faster than the Fed was raising the rates. The Fed raised interest rates by 0.25%, and then mortgage rates jumped up by 1%, a whole percentage point. And so yeah, so that's what we've been observing. That's what I've been observing. Now it says if rates do rise, they're saying that they don't anticipate that mortgage rates will rise above 6%. And they went on to say that they feel that mortgage rates could potentially fall shortly after, even if there is a rate increase. Quote, it says here, this is what happened after last month's 75 basis point hike when mortgage rates spiked by 50 basis points to 5.78% before eventually cooling down to the current levels of about 5.51%, according to Jacob Channel, who is LendingTree's senior economist. So could we potentially see a mortgage rate pullback? I mean, I suppose if mortgage rates grew faster than the rate that the Fed was raising interest rates, maybe some of these mortgage companies and bankers were like, hey, let's get ahead of this thing. Let's, not get behind the curve. Let's raise mortgage rates. And, kind of defensively, they got ahead of where the mortgage or where the Fed was raising rates. Maybe, possibly, if these banks and these mortgage companies start feeling the pain because they're killing their own business. If they could be a little bit more competitive, maybe they say, hey, we took advantage of the American consumer, the average home buyer long enough, and we're losing money because people have decided to stop even applying for mortgages. You know what? We don't need to be as high as we are on these mortgage rates. Let's pull back a little bit. Maybe we could possibly see some of these interest rates come back down. Now, if that were to happen, we may actually not see this slowdown in the housing market become as bad as many people are predicting. Are we going to see a housing market crash? Me personally, I don't think that that's in the cards, but we'll see how that plays out. Reports are saying that home prices are finally starting to drop from record highs. But every real estate market's different. Every real estate market is different. Here I am on the East Coast. I know tons of people all over the United States, and some people are saying that housing prices are still rising. Some people have said that housing prices have fallen, and other people have said that housing prices have actually been cut. But I've talked to a number of different real estate agents, and a lot of people are saying that they list these properties a little bit higher than they believe that they could actually sell it for. And so a lot of home owners who are selling, a lot of home sellers are cutting their listing prices to make it seem like they're offering a deal. And so it kind of skews the data because it seems on paper, and then of course it hits these headlines. Oh, the housing market is, finally hit its peak, and the housing market is softening, and maybe it is softening, but is the housing market crashing? Because you have to remember, like, the data can be manipulated. Let's not be naive to that. So let's just say you got a house, your house is probably worth, it probably would sell for say 550. So, to make your listing stand out, maybe you list the house for, it depends on what your strategy is and what kind of real estate agent you're working with. A lot of different strategies on pricing and how to get your house sold and how to get attention to your listing. So maybe your house is probably going to sell for say 550, right? So maybe the agent that you list with says, hey, let's list the house for, 585. And then like the next day you chop the price down to like 445, right? Or maybe even, not 445. You chop the price down from 585 to 545, or maybe even 550. So now you're right in the ballpark of where you think the house is actually worth anyway. And so on paper, and when reports are pulled by the National Association of Realtors and other different organizations that monitor real estate data, they're going to see, oh, all these different houses in this particular zip code have slashed their prices. Yeah, well, maybe they weren't like legitimate price cuts. Maybe that was a price cut built into the strategy that was suggested by either the seller of the house or the real estate agent that represented the seller. So just some things that I wanted to share with my investment community here. I know we talk about dividend stocks a lot, M1 Finance, dividend portfolios and whatnot, but this channel is all about passive income, growing your wealth, expanding your financial education, and I'm going to continue to bring good information I think that you guys need to know about, or at least consider as you continue to grow your wealth for you and your family during this financial journey. So if you got any value out of this video, do your boy a favor, drop a like for the video. Totally appreciate that. Also consider subscribing to the channel, and I will catch you guys on the next one. Take care and be safe.